Hey everyone, Meet Kevin here. Welcome back to another episode of the Meet Kevin Show. In this video, we have the honor of having Lynette Zang back on the channel, the chief market analyst from ITM Trading. Both her YouTube channel and her website are linked in the description down below. As usual, these videos are not sponsored. They're brought to you to bring you information and perspective. And with that said, we had a big thing happen in the markets today. And Lynette's going to tell us all about what happened today and her reaction. What does this mean, Lynette? What's happening?
Well, the 2-year yield went above, so it inverted above the 10-year Treasury bond yield. That is a big deal, and I've been watching the yields invert really since January when the 20-year bond yield went above, paid more than the 30-year bond. So this was not really a surprise. The moment that it happens, that's always a surprise because you're never quite sure. But what that typically tells you is that we have a recession ahead. Now, that wouldn't really be necessarily that big of a deal. There'd be a number of ways that you could protect yourself. But the real problem is that we are absolutely 100% at the end of this big fiat money, government debt-based money experiment. And they're out of tools. The central banks have no tools left because the key tool that they use to regulate the rate and speed of inflation are interest rates. And with interest rates being anchored at zero and the Fed in a position where they've been vowing to raise interest rates to fight this inflation that somehow magically they didn't create, but they did.
Yeah.
Right? They're really between a rock and a hard place. And it's just a matter of what are they going to fail at, not will they be able to pull anything off. Because if they don't have interest rates, then the only thing that they have
is the money printer.
That's it. I mean, it really is just that simple. And when that happens with all of the inflation, every time they do that, the value of the money out there goes down more. The purchasing power, the inflation. So they either heat up and stoke more inflation by printing money, or they raise interest rates, which they've committed to do, so they kind of have to retain their credibility. Either way, we are in deep doo-doo. And that's technical.
Now, Jay Powell tells us that, hey, don't worry, we'll be able to raise rates. We'll get to 2% or whatever, and maybe even a little bit above 2% by next year, maybe 2.9 or whatever. And you know what? We'll have a soft landing. We've done it before. We could do it again. What's your response to him if you were talking to Jay Powell?
I would say you are living on hopium, aren't you? Because historically, that has never, ever, ever happened. And again, between a rock and a hard place, now his job is to keep everybody calm and to keep all the wealth inside of the markets. That's his job. But I'm pretty sure he's not. I mean, look at the bags under his eyes. He's not sleeping well.
Oh, no. Ouch. So, okay, so the yield curve inverted. This often signals a recession. Some people say it signals a recession. Always signals a recession. Some say it takes about 18 months for that recession to come. What's your take? Is it going to come sooner, later?
Well, typically it does. It takes between 12 and 18 months. But that's when you still have some balance sheet to work with. With the balance sheet up at 10 trillion or 9 trillion rather, sure. Then, and supposedly they're going to run off the balance sheet. Not going to happen. It's not.
Oh, you don't think they're going to be able to pull that off?
No, I do not. No, I do not. I mean, I don't even a little bit think they can pull this puppy off because the last time that they tried in 2016, raising the interest rates and it was just not reinvesting the interest and the principal. Well, that led us to September 2019 when the money markets froze. That's the global plumbing financial.
That was the overnight. I remember this. The overnight rate shot up to like 10% or something insane because there was no liquidity.
Right. And isn't that interesting? Because they've been pumping massive amounts of liquidity in the markets, and yet there's headline after headline after headline of the lack of liquidity in the markets. How is that?
Yeah, that's interesting too, because I feel like then the repo market and money market funds, there was a lack of this kind of money. Now we've got this huge excess. Could that happen again if they start trying to run everything down again, where the market freaks out like it did then?
Well, you see all the volatility in the markets. The
That's a good
markets
point.
have been kind of freaking out because of the raising of the interest rates, since so much of this it's not just all the Fed printing, it's
Mhm.
all the additional debt that the corporations and everything with these 0% interest or near zero interest rates. So now this is, most of it is short-term debt that has to be rolled over, because you
Mm,
should never pay debt off. I'm being
sure.
facetious. I'm not being serious about that. But that is basically the theory, is that you never pay the debt off. You just roll it and take on more and more and more leverage. And so
Mm,
as long as the assets continue to inflate up, well, they can take on more and more and more leverage. And but as the Federal Reserve, and they have to, because if they don't raise interest rates now, it will, whatever little bit of credibility they still have in the markets, and that's been getting real thin,
yeah,
it's going to go away. And
that
I,
makes sense.
I would not, for any amount of even gold, to be honest with you, I would not want to be in Jay Powell's shoes right now.
Wow. Wow. That's
I would
incredible.
not.
Now, a lot of folks are making a big deal about whether or not we're going to have, a series of 7 to all the way up to 17, 25 basis point hikes. What are the odds about them just coming out and saying, hey, we screwed up. Here's a 2% hike because we are failing, or even the 50 basis point hike. Like what are the odds of a 50 or just a real big hike in your opinion? A rug pull, so to
Well,
speak.
it's going to be really interesting, because I think they're going to do 50% maybe
Mhm.
at this next meeting. They will never do a 2%. And
Okay.
even if they did, inflation is running so much hotter than that. So in other words, let's say that they magically somehow, there's no way. Okay, I'll put my neck on the line and I'll bet you anything. There is no way on God's green earth that there are 7 consecutive rate hikes in the
Wow.
offing. They just can't do it. And there's already bets that, and actually, even in their dot plot, they had already shown where they plan to lower the rates.
Right.
The only reason they're raising the rates really is so that they can lower them into this next crisis, which is already upon us.
Wow.
So,
Wow.
even if they did, though, you're still in negative yields,
Sure.
because if you're buying a treasury bond at, well, let's say 3%, okay, we'll be generous. They raised the rate 3%, but inflation is running at 10%. You're still minus 7%.
Yeah, that's terrible. But now, what do you think about, we've I know the word transitory has left the Fed because that was a big embarrassment, right? That was laughable, right? But there's this argument that, hey, if maybe the war ends and then we get like commodity prices back under control and the supply chains catch up, maybe inflation can go down. Is that just, as you said earlier, hopium, or what's your take on inflation going down?
No, I've been feeling, even though I don't have absolute technical confirmation, so I could be wrong. This is purely my opinion,
Mhm.
except that I do think that because we are at the very end of the currency life cycle, that we are at the beginning phases of the hyperinflation cycle.
Oh,
We
wow. Okay.
have to burn off the debt in order to go into the new monetary system. There
I
is
see.
no other option, because the only thing that I can find so far is that the new system will be based upon accumulating debt as well. So they got to get rid of the debt that's there, because it's at nosebleed levels. You
So,
know,
so you think maybe the way to just deal with the debt is almost hyperinflate the currency and maybe start over with some other currency, and because everybody would lose trust. I mean, if we had hyperinflation, nobody would trust the dollar anymore. We'd lose the petrodollar status, the world reserve currency status. It would be bad.
well, we're pretty much losing all of that right now. I mean, the IMF just came out with a working paper in February talking about the stealth loss of the US dollar's reserve status.
Oh,
And
wow.
proceeded to show us, how, yes, indeed, you've got it was actually a really interesting report, an interesting read. And you showed the loss of 10% in the use of the dollar over a short period of time and the rise of alternative, non-typically reserved currencies rise of 10%. And the interesting part that they pointed out was the currencies that have gained that reserve status or more of that reserve status are countries that most of them, not all of them, because Canada has no gold,
Right.
but have been the countries that have been accumulating gold, the emerging markets that have been accumulating gold. And I thought that was fast.
Here?
Yes.
The stealth erosion of dollar dominance. Wow. Yeah. From the International Monetary Fund. Wow. Okay. I'll have to read that. Thank you for that.
Oh, you're very, very welcome. So, we are already, and we're watching oil that can now be purchased in yuan and ruble for oil. So the petrodollar is essentially, if it's not absolutely dead, it's on its last legs.
Wow.
Right?
What implications does that have for, like, people watching at home, whether it's real estate or stocks or gold or bonds? Like, what's the fallout for people?
Well, the huge advantage to being the world reserve currency is that everybody in the world has to hold dollars, right? So it creates an artificial demand. That demand, if they can wean away from the dollar slowly, those dollars come back, create more loss of purchasing power, so more inflation, but they do it in a steady way. If, on the other hand, the world says, forget this, we can see that the central bank, that the Fed has no more control. And, what's just recently happened with Russia being cut out of the SWIFT system, which is the global payment system for dollars. These things have ramifications that we haven't even felt yet. But what I see is that if all of the countries are not holding as many dollars, that artificial demand is going away. And therefore, we become a local currency just like any other local currency. And we're dealing with a lot more inflation because we've been the world reserve currency.
I see. Okay, because so everything around us that we import then becomes more expensive because our dollar has less purchasing power internationally. So all of our costs are more expensive. So costs here go up and we have more inflation at home. That sucks.
Right. And then when that happens, as it's happening, is people are seeing that and they're losing confidence in the system and they're losing confidence in the central bank. And this is a con game. So therefore it requires confidence. And that's why they're always testing it. I'm dead serious about that. That's when the hyperinflation.
That's why they're testing confidence because it's a con game
constantly. Yes. It's think about this. It's consumer confidence. It's inflation expectations, and they need to be anchored.
Right.
They test confidence all the time.
Yep.
Because they absolutely know that the only way that this monetary system works is if the public trusts that this dollar can never go away, even though it has been going away since the day you were born, since the day I was born, since the day anybody that was born after 1913. The value has been going away, and it's been creating inflation that creates nominal confusion.
Yeah.
We get married to numbers. We've been taught to marry numbers, right? So you see the stock market going up. You see crypto assets going up. What can you convert them into? Because if the only thing you can convert them into are dollars that have no value, well, I don't know, you tell me. But the last time I checked, 10 trillion times zero was zero.
That's a good point. So what do I mean, yield curves have inverted. What do you take of this recession? I mean, is this an '08 all over again?
Way
Housing,
worse.
stocks, like where's the pain? Is it worse?
It's way worse because in '08, honestly, that's when I knew the system died,
Oh
right?
wow.
And it really did. And all they did was put it on life support and start all of this massive QE, all of this
Hmm.
massive free money printing, dropped interest rates to zero. That was to, and if you remember back then, the central banks were talking about the reflation trade, right? So they targeted what was they were going to, it's like a balloon, pump that air back into stocks, into bonds, and into real estate. And it
Hmm.
was primarily because that's visible to the public, but but key in here are all the bets that were created, the derivative bets that are created on top of all of those assets. So, yeah, I mean, if everything is done on debt and people default on that debt, corporations, hedge funds, they default on that debt, then what do you think happens to those assets?
Ugh, yeah, that's no good.
But
So
let me just kind of continue
please,
more than one thing because you asked me about gold
yeah,
too.
yeah.
Okay. And gold is the only asset that has actually been suppressed because a rise in gold price is an indication of a failing currency. And they do
Mm.
not want you to understand that the currency is failing and all the ramifications like we've been talking about.
Hmm.
So I'm not looking for Wall Street to tell me the value of this. At some point, this is an absolute fact. Here's one guarantee I can give you. At some point, every single asset goes to its fundamental value, which is actually not Wall Street's definition, but the true value for which that asset was created for. So, not what you wanted to do.
Mhm.
Gold is the primary currency metal, and it has been for 5,000 years. Okay. And that's because, unlike any other financial asset, it has the broadest base of buyer because it is used across the entire global economy, every single area. So it's used in manufacturing, it's used in finance, it's used in art, it's used in food, it's used everywhere. This is the only financial asset that can say that. And critically, it is the only financial asset that runs zero counterparty risk. And that's
Mm.
why central banks are accumulating it. And in fact, have accumulated more than they have in 31 years, the
Wow.
highest level of accumulation.
How do we see that? What they're accumulating and then if they're accumulating it, how do they suppress the prices at the same time? Like where's that
Good
disconnect?
question. Okay, well, you can go to gold.org or you can just do a search on
Mhm.
central bank gold holdings
Okay.
and or you can watch my work.
Sure.
I typically publish that stuff on a pretty regular basis. Now, the way that they can be accumulating all of this, and they're not the only ones, but the way that all this gold can be physical, can be accumulated, and you can see the price suppressed is through spot contracts. So
Mm.
on the COMEX exchange, because one contract, and there are a number of different sizes, but for example, one contract that controls 500 ounces of gold costs a regular commercial bank like JP Morgan $150. If you're a central bank, it costs $110.
Ah,
They literally control about $1 million worth of gold.
wow. Huh. That's
And
quite interesting.
oh, yeah. And the Bank for International Settlements, which is the central bank or central bank, I didn't know print screen then, unfortunately. I mean, I
Oh, sure.
wish I had. But I saw with my own eyes, so I can verify this without a doubt. For every 1 ounce of physical gold that exists, there were 62,000 ounces of derivative gold, which is digital gold that does not nor ever will exist, because anything
Mm.
physical, there's a finite amount. So it's pretty easy to manipulate the price if the world is reading 62,000 ounces to one, and
Hmm.
at a cost of $150 or $110 for a million.
I'm writing this down. This is very interesting. Then, so yeah, gold.org, you're right, has sort of a little bit of a guide in terms of how much they have. And you're saying they can hold it physically, but then they also just play the derivatives market, which is probably just a mess and a bad idea, huh? I mean, that sounds like '08.
This is so much worse than '08.
Well,
I mean, but yes, look, there used to be, and there still are, some legitimate uses for a derivative. And derivative, you think about it, comes from derived, the word derived, right? If I'm a farmer and it's January and I'm going to sell my crops in September, and I don't know what is going to happen with the weather or anything between now and then, or the market, and I want to ensure that I'm going to live another year to plant my crops, then I will buy a derivative contract against whatever I'm growing, wheat or whatever. Excuse me. And so if by the time it comes for me to sell my crops, everything's fine, that's just an insurance cost of doing business, no big deal. If, however, something bad happens, now I've guaranteed my income. That's a legitimate use for a derivative. But in the 90s, Wall Street taking over the derivative markets, now there are derivatives on everything, and you can never convert it into the underlying asset. And when I had done some studies, the last time that I did this, there were 1.48 quadrillion in notional value derivatives.
oh my gosh.
Right. Now, that is simply the value that Wall Street has put on those contracts. It does not reflect the real value at risk. And the BIS says that, and the IMF says that, and the FDIC says that, and the Fed says, everybody says that. So it's well admitted that that's just the value that Wall Street has put on the contracts. What's really the value at risk when that puppy explodes? And that's really our death knell.
Wow. So what? Okay, so if there's a manipulation in the gold market, what should people do? I mean, well, how does silver compare? How does Bitcoin compare? How do commodities, like even steel, compare? How do these other things compare?
Well, let's talk about commodities first, like steel and copper and those things. And those are manufacturing metals. So therefore, you need to have a vibrant economy to have that demand, right?
I see.
When we're talking about cryptocurrencies, really that too is purely these days especially, a Wall Street driven market where they're incorporating those cryptocurrencies. But I can see some use cases. It is really easy to transfer money from, America to Russia or China or wherever. It's easier to send it over. You don't have to ship it like you'd have to do with gold or even with silver. However, it's really the blockchain technology that has more value. And I really fail to see that the central bank will go, we've had this great run, couple hundred years. It's your turn. So while I do know that cryptocurrencies, and I would say really their central banks are going in with central bank digital currencies, CBDCs.
Yeah.
That is still in play. That does not have a very long history. I don't really think it was a coincidence that Bitcoin was born in January of 2009, and they started the heavy duty QE in March of 2009, and the NSA came out with a white paper in, I think it was 1996, on how to create a mint, talking about developing the cryptocurrencies. So, I could certainly be wrong. This is my opinion. But I do think that the cryptocurrencies were created to get us used to working in the digital realm. so that it was easier for the governments to transfer our habits from just cryptocurrencies to CBDCs, programmable money.
Interesting.
Exactly what they are. So this
what?
gold and silver are proven over time, and they're physical. If you don't hold it, you don't own it, and your perception is not relevant in a court of law. Plus, all of those other assets that we talked about have limitations on where they are used. These don't. These are used in every single aspect of the global economy. They therefore have the broadest base of demand, and they've never gone to zero.
Wow.
Fiat currencies always go to zero. And we
So
don't
not a big fan of like the ETFs like IAU or GLD for gold or whatever.
No, because all you really have are shares of a trust. You don't have access to the underlying gold. And that trust was developed to mimic the manipulated spot market movement.
Oh, I see.
And with silver, they changed the prospectus because, and silver is ridiculous at 26 or 25 bucks an ounce. It's ridiculous because they had to change the prospectus on SLV because they could not get silver to create the baskets to create the shares. So if you read the prospectus, it tells you, yeah, it doesn't have to really reflect the true price. It's just going to mimic whatever the spot is. Yeah. So, if it's intangible, you could create as much of it as you want, especially if it benefits the powers that be. But with this stuff, no, there's a finite amount of it. And when it's coming off the market, it's not going back on the market again. And so even the choices that we used to have, we don't have them anymore. Some, thank goodness.
And so one thing that really caught my attention was you saying rising gold prices is a sign of a failing currency, and that maybe it would make sense to try to manipulate the value of gold down, at least in Wall Street's eyes, to make it seem like the dollar's okay. Don't worry, nothing to see here. Can you speak a little bit more to that? Like, is that like, if you own gold, should you be looking at that as like, hey, I'm going to have a bit here, I'm not so worried about the daily price fluctuations or whatever, it's like my emergency fund? Like, how do you allocate this in a portfolio?
Well, okay, first of all, since 100% of the time all assets go to the fundamental value, you have to determine what that fundamental value is. And I could tell you on a minimum basis, because this is how they reset a currency, is against gold as the primary currency metal, that the minimum that it would go to if they did the reset today, because I just ran these numbers a couple weeks ago, would be $13,500. Now,
per what amount? Ounce or
per ounce? Okay, so with spot at like 19 whatever,
100, yeah,
huge bargain. So I do not care about the daily fluctuations because I am not a trader. Just like the Queen of England, and this may make you laugh, but the Queen of England does not even know how much her crown jewels are and her gold is, because it doesn't matter. They always have value. And the more of this funny money that gets printed, the higher that number goes. So if you look at what happened in Venezuela, who has done an overnight reset so far 3 times. That's usually about how many times that happens as a currency is going through hyperinflation. But it can certainly happen more, or it can certainly happen less. But overnight, after they suppressed it, it went up over 3,500%.
Wow. And now, how are you diversifying your portfolio then? I mean, with this inversion of the yield curve, is it what, like real estate, crypto, gold, silver, stocks, allocations of these? How do you fan it out?
Food, water, energy, security, barterability, wealth preservation, community, and shelter. So that is what I convert these things that I earn into, with my biggest allocation to gold.
Okay. Oh, so also real estate.
Oh yes, definitely. I mean, but not investment real estate.
I see.
You got to have a place to live.
Sure.
And I have a bug out property as well, which I will be, I am developing. So there is a time, because I've also studied what happens to real estate during these periods of time. And they're
What's
really,
your take on that?
well, I mean, right now it is severely overvalued. And I am seeing signs that we have already reached the top of the market. I know the prices are continuing to go up because we get nominally confused with numbers, but all of that is done on debt and leverage. So depending upon what happens in the future, and I did a piece on this, I don't know, maybe two months ago, you think, Edgar? Maybe 3, something like that, on what actually happens. So you can go in and look at the specifics there. But I can tell you this, in Germany, 1 ounce of gold would buy an entire, or 25 ounces of gold rather, would buy an entire city block, buildings and all, during the hyperinflation. Because food becomes the single biggest issue. So people are gonna spend whatever they can and whatever they have on food. They're not gonna worry so much about rent or their mortgage. And we've already seen through this COVID epidemic that came out that they capped, they put mortgages and rent on moratorium. And that's typically what happened. Happens during these periods. They fix prices. They say you can't go above this. So for those people that are doing investment real estate, you just better have enough gold that you could pay off the mortgage and continue to pay your property taxes and not be dependent on the rent, because it's going to be very tough for you if you do.
And so what kind of downside would you see in the stock market for those who are holding stocks, whether that's the S&P or NASDAQ, during a recession? And how long does that kind of downside last? I mean, is it something that's going to wipe people out, or how long do you project something like that lasting, and how severe?
Oh, I think it's going to be really severe this time because, there's just not much room in the balance sheet, because there's not enough confidence to give the central banks enough room in the balance sheet.
Right.
And if you look at what happened from 2008, 9, 10, they really, with all the money printing, they truncated all of those losses, whether it was in real estate or in stocks. And, with bonds, when interest rates go up, I always use my little sterling silver chopstick. But when interest rates go up, the principal value of the bond goes down. When interest rates go down, the principal value of the bond goes up. So what really happened was the interest rates were going up and the bonds were going down like that. But then they moved in and the central bank started buying bonds, right? So they pushed the interest rates down. And that's why they're between a rock and a hard place right now.
Can't do any more buying.
Yeah, they need to push the interest. We're going to recession, or to keep all these markets floating, they have to make it cheaper to borrow and spend. And they can't do it right now.
If we go into a recession, we would see inflation go away. Would there be, presumably, no? But tell me, what do you think?
Not anymore, because of where we are in the trend cycle. And inflation never went away anyway. If you go on to the federal, and maybe you can pull this up, the Federal Reserve FRED, FRED, purchasing power of the consumer dollar. I mean, that's probably my single favorite chart. If you said you can only love one chart, which one is it? That's the one.
It's just the line that goes straight down. What's going on here?
Right? So regardless of strong dollar, whatever, exactly. Now, if you see where they have dates, because when they first created it, if you go to the left-hand side,
13.
My left-hand
1913.
side. Right. 1913. That was $1 worth of purchasing power. And then they printed $2.4 for every dollar's worth of gold that they had. That's why you see that 50% dip. Then you got the roaring 20s, right? You might remember that. Stock market, real estate bubble. And then in 1929, they stopped supporting allowing more credit. And I mean, there's lots of stories about it. I'd love to have a conversation with the ex-Fed chair Bernanke, because he thinks he's an expert on this period of time.
Oh,
I don't think so, but you can see now the purchasing power, that big wide gray band, all the gray
yeah.
bands represent recessions. So do you know of anybody, have you ever heard, did you ever read in any history books where things got so much better and cheaper for people during the Depression?
Oh gosh, so much better or cheaper for people. I mean, hopefully things got cheaper for people. But I
Well, it
guess
was the
if people
Depression.
lost their jobs, it doesn't do you any good.
It was a depression, right? And
Yep.
that's where we're headed, way bigger. A depression is just a
Wow.
deeper recession, right? However, that was kind of the kickoff to the end, because that's when they took the gold away from the people so they couldn't protect their purchasing power. And then after that, it was downhill. If you would go up to the date and put in, can you see where you can change the date? Yeah, in
Sort of
there.
narrow the date down more recently, maybe.
Correct,
Okay.
exactly.
What years would you like?
You could start at 2008 would be fine, or you can even just go back to the last year. It looks pretty nasty.
Yeah, this is since '08. Here, let me get rid of myself. There we go. And yeah, this is since '08. Consumer Price Index, purchasing power of the consumer dollar and the U.S. city average. So this is since '08. So our purchasing power has gone down from a measure of about 46.4 down to about 38.7. So what is that? About 20% or so. And then just from 2020, it looks like we've gone from about a high here of around 39 all the way down to about 35. So another, 15% in just the last couple of years here.
And look at how much more quickly that's happening, right?
This is accelerated over here. Yeah.
Exactly. So I know someone asked me earlier about a strong dollar, in a recession, and oh, look at how strong the dollar. What they're talking about is one fiat currency against another fiat currency. But does that really
Yeah.
matter to you and me? No.
Yeah,
What
that's a good
really
point.
matters is going to the store and buying stuff,
Hmm.
buying food for our family, putting gas in our cars. And that's what erodes the confidence that pushes us into the hyperinflation. And let's keep in mind, the only difference between inflation and hyperinflation is the speed of that inflation. And as you saw from that purchasing power chart, it's speeding up.
Right. Ugh. Yeah, no kidding. So, a lot of folks like to say, well, the inflation has to happen year after year after year for us to keep getting these high reads, right? If I sell something for $100 and then it's 110, that's 10% inflation. But now I got to get, to 121 to have another 10% inflation. So we got to see that year after year after year after year. Otherwise, we have those high base effects, and maybe we'll have lower inflation. If we just stay at 110, hey, we had the 10% once, not seeing it again. Is that possible, or is that also hopium?
Well, inflation in and of itself is a fiat money phenomenon. It's not a monetary phenomenon, right?
Okay.
So if they can keep that rate, like you saw on that chart, it looked, actually, when you scrolled out, it looked like it wasn't moving at all, right? But when you then zoomed in, you could see that, yes, it continued to decline. If they can keep that at 2%, they rob you of your purchasing power and your wealth, but you don't realize it and you don't complain about it. When it happens more quickly, like what we're experiencing, then it's more noticeable. So to you or to the public, is that really a stable currency when it keeps going down? Because that doesn't seem stable to me.
Right.
Right? So, it's all relative, especially, think about this. 1970, the average wage was $9,500, and a family of four could live on $9,500 with one wage earner.
Right.
Today, what's the average wage like? And it's probably a little bit higher
55, 60. Yeah.
Something like that, right?
Sure.
And you need two wage earners, you're paycheck to paycheck. And what did they stimulate? Anybody that made less than $150,000 a year. And I could tell you, because I was there in the 70s, If you made 150 grand, you were really, really rich.
Yeah, good point.
It's serious. My father was a developer, and I don't know why this always stood in my mind, but he used to work out of the house. And I remember standing in the doorway. My parents had just finished working with a young couple. He worked for IBM. He was an engineer. And my mother pounds her fist on the table and she goes, he's a comer. He's a comer. He makes $12,000 a year.
Oh, wow. Yeah.
Right. And my father built a really nice house. So, you stop and think about that. They went out every weekend. I used to babysit for them. They'd go on vacations. They probably were able to save to educate. They had 2 kids to educate their kids. So put that in relative terms today, and you can kind of see where, well, do we need it to go that fast, that long?
That makes sense.
The purchasing power has absolutely eroded, but the speed will, I'll go 99.8. The speed is going to escalate. It's not going, the supply chains are not going to be repaired so quickly. Here's the other piece, Kevin. Here's the other piece. In the 80s, when I became a stockbroker, all the talk was about globalization. And I remember thinking to myself, I can see that this could be a problem. So we shipped off all the manufacturing, et cetera, et cetera. Well, what's been happening over the last several years has been deglobalization.
Bringing it back home, the Trump build it American, whatever.
Exactly. And now with what's happening with the supply chains, that has taken on a lot more urgency. Right. So it was pretty destructive on the way in. It's going to be pretty darn destructive on the way out.
Oh, because a lot of folks make this argument that, hey, well, inflation's gone down because of, hey, aging population, technology, but big one, globalization, using cheaper labor. But now if we bring that home, hey, that's an inflationary pressure.
Yes. And if you think back to that purchasing power chart, even with the globalization, right? Yeah. What happened to the dollar? It didn't stop going down. It didn't just go flat. It kept going down.
And so you mentioned you don't think the supply chains are going to be repaired. Is that just a way of saying not anytime soon because you have to build factories and it takes time?
Exactly. They dismantled our manufacturing. Now they have to put it back together again. And you don't do that overnight.
So some folks say that maybe if there's inflation, then companies have purchasing power. They can raise prices, and maybe inflation's good for stocks. What's your take on the argument that inflation could be good for stocks, and maybe, hey, the stocks will just go to the moon?
Well, they won't go to the moon because nothing goes straight up.
Sure.
But in theory, and that this is the way the system has been built, that yes, if a stock has the ability to raise prices, then that is an inflation hedge, except that they are starting to get pushback. Macy's tried to raise prices on mattresses and I think chairs, I don't know, a couple of items, and people really gave them a hard time. They had to stop raising their prices. That's been happening not just at Macy's, but at other manufacturers. So when incomes, and you also hear how much more people are getting paid because there is a labor shortage, but inflation is running way hotter than the increase in the wages. So no, a tree does not grow to the moon from the earth, and there are limitations to how high they can raise that prices before people. Right now, people have to make a choice between putting gas in your car or food on the table. A lot of people, unfortunately, have to make that choice. And we have a massive problem on a global basis, but country to country too, with hunger and starvation. Right. Because we've also taught people how to be dependent upon the grocery stores.
Yeah,
and
sure.
We saw what happened, right? Still shelves are bare.
If that aggregate or total demand goes down for consumer goods, like Macy's sofas or mattresses or whatever, buying stuff online, Amazon, Etsy, whatever. Could that be the start of potentially inflation coming down, or is this just money moving over to now energy and gas, and you're still inflating?
Well, you're still inflating, and so there might be some deflation in those areas that a lot of corporations, I mean, if you go into the Fred again and you look at corporate profits, I mean, they are to the moon, right?
Yeah.
So we've got that K-shaped recovery. Well, most people are down at the bottom of the K, not at the top. Yeah, you could put corporate profits. I love that website. It's probably more honest than any other Federal Reserve website, because who really goes and looks there but us nerds. So there might be some things that lose a level of inflation because people stop buying them because they can't afford them. But there's a massive problem with what's happening in the food supply chain. Fertilizer, oil, all of these, the seeds, everything. And we need to be a lot more independent from the system if we're going to make sure that we can feed our families. That's been a big push for me, really, since 2010. That's when I bought this property and I started creating an urban farm. And so, yes, I'm a farmer.
Becoming less reliant on those supply chains. So here's that chart you're talking about, and it's here. I'll keep myself away. Corporate profits after tax, and then the IVA and CCA. Those are adjustments. Probably less important to look at the adjustments. More, I always like to look at the inflection points or changes in the graph. And like what you're saying here, I mean, look at this explosion in corporate profits. I mean, corporate profits relatively did nothing between 2012 and 19. And then the pandemic comes in. Here's the money train.
Exactly. That's exactly right. And, you think there's not price gouging? That chart tells you there's a lot of price gouging.
That's a good point.
But humans, people, the public, we all have our limitations on, what we're going to do. And I'll be honest with you, regardless of how much money you have, I don't remember what it was. But the other day, something came in and I could have afforded it if I wanted it, but the price was just stupid. It was just stupid. And I said, I'm not going to do that. So whether you have money or you don't have money, I think we all have our limitations on what we either have the ability to do or what we're willing to do, either one.
That's a good point. It's able and willing.
Exactly. I don't even remember what it was. I could have afforded it, but I was like, no.
So what you're saying is all in on Tesla stock.
Yeah, I probably wouldn't do that. I personally do not, and I'm an ex-stockbroker and I'm an ex-banker. So and I'm a techie, which means I'm not with the technology, but I know how to read the technical language of the markets.
Sure.
I don't own one stock. I don't own one bond. I don't own one fiat money product. I have cash because that's our tool of barter, but I have a level of cash that I must maintain because I'm running a business and I want to make sure I can pay everybody. Yeah, and I have a lot of cash out of the system. I keep a minimal amount inside the system.
Wow. Got it. What about fears of oil? What's your take on this? How long is this going to last? Is it all just war related? Is this something? Is this going to keep sapping consumer purchasing power through the recession?
What's your take? Put that in the Fred and look at that chart.
Yeah, no kidding. Straight up on
oil, because it used to be $20 a barrel, right? And then when we went into the 2008 crisis, it went up, I think, to $140 a barrel. And then it came down, but it still never went back to where it was prior to that crisis. So, and oil, there's a finite amount of oil too. So all of this talk of moving away from the system before they built the infrastructure, there's one that says max up by where you did on the other side of that.
There you go.
There you go.
Here's your Brent crude. So your European oil, look at that over time, going all the way back to, we got 87 on this chart here to now.
Yeah.
Wow.
And so, it was a lot lower before we went into 2008.
Yeah. No
right.
kidding.
And then, of course, remember, it went into negative territory there for a heartbeat.
That was something.
Wasn't it something? Um,
Yeah,
but that's a trading vehicle. I mean,
sure.
the problem with everything is that because it's been the banks that have been controlling everything since 1971, the whole world, every asset has been financialized. In other words, turned into a financial product, whether it's
Something to bet
physical,
on.
like real estate, exactly. And then it's handed over to traders and that are able to borrow at basically zero,
Yeah.
less than the government can borrow, which never
Yeah.
makes sense to me. But hey, because who's paying for it?
You
And
know, I wanted to
you
short
have.
treasury bonds the other day, and I called up JP Morgan and I said, "Hey, how much is the borrow if I want to short treasuries?" So they look, pull up the ticker, TLT. All right, that says here the borrow rate is negative 0.58. And I'm like, "You will pay me 0.5% to short treasuries right now." And they're like, "Yeah."
Okay.
Nuts.
Does that make any logical sense at all?
No, because see, I was prepared to pay to short treasuries because I knew the rates were going to go up. I mean, I thought they were going to go there, but anyway, that's
Well,
weird. So,
it's you know yeah. I mean, you can actually if you look at the patterns. I'm huge on patterns,
sure.
and if you look at the patterns on the graphs, you can see when all of this. You can see the transitions whenever this happens,
Uh,
and that's why you can see the currency's life cycle and know we're at the end. So you got to
ugh,
do something to protect yourself so that all your wealth doesn't evaporate into a hyperinflationary mess.
yikes!
And that's
Yeah,
what
yeah.
gold and silver about.
So I want to just pull up the 10-2 here, which
Yes.
is just inverted. You know, I'm going to pull this up, and I want to know like your thesis. Are you thinking next summer for issues? You know, here's just for the viewers watching. Here's the spread between the 10-year and the 2-year. When it falls below roughly the white line I threw on there,
Mhm.
I kind of missed it. I put it at -1 basis point, but whatever. Roughly where that white line is. This is the inversion. So we've had the
Mhm.
inversion over here in the late 80s and then a recession. The inversion over here before the dot-com bubble and then recession. The inversion over here before the '08 bubble and then recession. Briefly, I believe very nominally, we briefly inverted here in 2019. And then
19.
we did actually have the COVID recession, which people
Mhm.
are wondering, like, did this just delay that recession? I mean, here we are again. So
Mhm.
we're singing this song again. It doesn't look good. I mean, it makes me nervous, but I don't know. What should people make of this?
They should get ready. I mean, when do you want to be prepared for a crisis? If you wait until you're in the middle of a crisis, like you look at what's happening in Russia with the population, the Russian central bank has halted their gold purchases because the demand from their citizens as the ruble is being decimated
Right.
I mean, it's in a frenzy. And so gold in terms of rubles are ridiculous right now, right? So
Mm,
when do you want to get ready? You want to get ready before you need to be ready. And
I see.
personally, I'd rather be 10 years too early than even 1 second too late because
Mm,
that's when you lose every single choice.
ugh, that's a
And
good
that's
point.
what I make of this. Do I think that the recession could hit in the summer? Maybe. I mean, it can happen anytime because the Fed is already way behind the 8 ball and making mistake after mistake after mistake and telling you everything is fine because that's their job. They can't
Yeah.
come out and tell you what they really think
Ugh.
because then
Yeah.
you'd make different choices.
That's a good point. So, okay, how can people learn more about your perspective on this? And you have a YouTube channel. Tell us a little bit about that and your website, ITM Trading.
Well, ITM Trading is a physical gold and silver dealer. That means that anything you get from us, unless you do it inside of an IRA, we're shipping it to you. You're going to hold it, you're going to own it, and run no counterparty risk. But really, we execute a strategy that's based upon my studies of currency life cycles. And it's a strategy that I created for myself, actually, before I even went to ITM. Because when I went to ITM is when I knew we were at the end in 2002. So I've been there for almost 20 years, June 28th. And so I knew that it was at the end because that's what the formulas told me, and they're smarter than I am. So, I listened to them. But Everybody that works with us is we help them develop their own personal strategy that is like mine, but then tweaked for whatever your personal goals are, circumstances. I mean, you're at a different stage in your life than I am, so it's going to require a little different planning. But if you want to see my work, then you go to the YouTube channel. So you can go to YouTube and just put in ITM trading, or you can search my name and I'm pretty sure it'll come up. And I do not publish as much as you do, but I do publish like 3 times or so a week. And I do these interviews. And actually, we just opened up a new YouTube channel to address the rest of my mantra. So the food, water, energy, security, community, and shelter piece, where we're focusing on that. So on the main YouTube, the ITM channel, we focus on, I try and teach you how to see these patterns so that you can make educated choices that puts your best interest first. And I give you the links, just like you pulled those up. I give you the links to all my research so that you can do your own due diligence, because I don't really want you to take anybody's word for anything. I want you to really come to your own conclusions. So I make it easy for you. Okay. You don't have to research it. You can just click on the link and you can go there and read too. You have a different opinion? Rock and roll hoochie coo. I can't tell you that it's wrong, right?
Oh, that's awesome. That's a good point. Yeah. Well, so I've linked both of these down below, your YouTube channel and ITM Trading. Anything else that you want to add? This has been very enlightening, and it's something we got to pay attention to. This inverted yield curve and some risks ahead. Anything else that we missed?
I mean, there's so much that's going on. I mean, there are patterns that you see every single time you transition from one currency system to the next. And I'm seeing all of those patterns right now, and you need to be aware. I mean, that's really, if you'd been listening to my work for years, I would have said, there is always a war. I don't know where it's going to start, maybe the Middle East, maybe somewhere else, but there's always a war. There's always an issue around energy. You go back to the 71, you had the Vietnam War, you had the oil embargo, you had the civil rights movement. We've got a lot of civil rights that are going on right now, and others. So learn what the patterns look like. And when you see them, please believe them. Don't go into denial. Oh, the dollar could never go away. They know this. They knew it when they created the system. They know it today, that if they can keep things as normal looking for you as possible, you will not realize that any change has happened, when in reality, so much has changed and so much is changing. No time to procrastinate. Don't stop. Stop. The dollar's not going to gain its value. You saw the chart. It hasn't in all that time. It's not suddenly magically going to happen now. Get physical gold and silver in your possession. Have a plan. Make sure you have food, water, energy, security, barterability, wealth preservation. Community is probably the biggest key, and shelter, because we need to come together. That's why I do these interviews. This is community for me. We need to come together to help each other. This is not going to be fun for anybody.
Yikes. Well, Lynette, thank you so much for this. For anybody watching, thank you so much for watching. If you found this helpful, make sure to share the video. Check out Lynette's YouTube channel and her website, link down below. Lynette, stand by for a second. Everybody else, thank you so much, and we'll see you in the next video. Thanks so much. Bye.